So big news came out of the Disney's earnings call. Now, if you're a Disney investor, this is definitely something that you want to pay attention to because this might make you either double down your investment or rethink your position entirely. But anyway, I was just doing some regular browsing, catching up on investment news, and I came across an article from CNBC about Disney. Now, if you've already listened to the Disney's earnings call, you're probably familiar with what was said, but if you haven't, we'll take a look at what was said and what this means for investors, whether you're a current investor or you're a prospective investor looking to invest in Disney. So let's take a look at the article from CNBC and then we'll break it down. All right, so taking a look at the article, the headline reads, Disney to cut 7,000 jobs and slash $5.5 billion in costs as it unveils vast restructuring. Disney said Wednesday that it is planning to reorganize into 3 segments while also cutting thousands of jobs and slashing costs. The media and entertainment giant said it will now be made up of 3 divisions. Disney Entertainment, which includes most of its streaming and media operations, an ESPN division that includes a TV network and the ESPN Plus streaming service, and a Parks, Experiences, and Products unit. On Wednesday, during its quarterly earnings call with investors, Disney also announced that it will be cutting $5.5 billion in costs, which will be made up of $3 billion from content, excluding sports, and the remaining $2.5 billion from non-content cuts. Disney executives said about $1 billion in cost cutting was already underway since last quarter. The future of ESPN under Disney's ownership has been a question for some time for investors. Last year, Third Point, which is led by activist investor Dan Loeb, had urged the company to spin out ESPN. Disney and Third Point later reached a deal after reversing course on its thoughts for the future of ESPN. Alright, so let's get right into it. As you're probably aware, ever since 2020, Disney's stock price took a little bit of a hit during the pandemic and hasn't really fully recovered since then. And it was during this time that Disney had to cut its dividend, or I should say suspend its dividend, which resulted in a lot of investors selling out their position on the stock and the stock taking a nosedive. Now, around this time, Disney also introduced a Disney Plus streaming service in the hope of generating some revenue. And so far, it looks like it's been able to help them navigate their way through the rough times and offset the impact of their parks and theme parks and the Disney resorts and the Disney cruises being forced to close as a result of the pandemic. Now, with regards to the latest news that we're seeing, there's a few key things that we need to pay attention to. The first thing, which was mentioned in passing here, is the return of CEO Bob Iger. Now, Bob Iger was the CEO, I believe it was since 1995 or 2005, I don't recall, up until 2020 when he stepped down. But ever since then, he actually came back in November of 2022. So under his leadership, he's proceeded to restructure Disney into these 3 entities that were spoken of on the call, which were, if I remember correctly, Disney Entertainment, ESPN, and Parks, Experiences, and Products. But I believe this is overall a great strategy because if you look at Disney is such a complex entity with so many revenue streams that organizing and restructuring the brand into these 3 major categories helps simplify your operations, not only for the company, but also for investors, because now it helps them identify, or helps all parties involved identify the various revenue streams and also, have a sense of which revenue stream is more profitable, and also on the reverse, which revenue stream might be less profitable that, requires further analysis or, might require some cost-cutting measures, for example. Now, speaking of cost-cutting, I am really convinced without a doubt that there's probably going to be some areas within those 3 main pillars that will definitely get cut. I'm pretty sure that among these cutting measures, TV channels will probably be one of the places where the focus is as Disney continues to move towards more of a streaming service. But for now, I'll say the media and entertainment pillar overall is profitable. Now, ESPN and ESPN Plus, those are sports entities, so I'm not really going to comment on that because everyone is familiar with ESPN and they're just going to keep chugging along as usual. But the main thing here that I want to highlight is the Parks and Recreation. Now, this is the first time, I believe, since the pandemic that the Parks and Recreation segment is looking pretty good and they have an optimistic outlook. This is the first time that we're seeing the traffic return to levels that mimicked pre-pandemic era, and that is a very, very good sign. Now, as we go forward and more people continue to go to the Disney resorts and also, go on Disney cruises and things like that. That revenue segment is only going to keep bringing in more cash flow to the business. And also when you consider this, plus the fact that they've also been raising prices without slowing down the number of people that are actually going to these resorts. And that's a very positive thing. I myself actually know quite a handful of people that made a trip to Disney within the past month alone. So that, as an example, shows just how far of a reach the Disney brand has in enticing people to come into its theme parks and its resorts and its cruises, which will result in more traffic equals more money, money equals more revenue, Of course, they're raising prices. So but I think it's a very, very, very good thing for Disney overall. Now, the next thing I want to mention here is management. Now, Bob Iger, who was a former CEO of Disney, he's been responsible for basically Disney as we know it today. He took Disney from what was a $50 billion company to around $200 billion, which it is at today. He's also responsible for the acquisition of Marvel and Lucasfilms, which owns the Marvel characters and Star Wars that we all love, and also was behind the introduction of Disney+. So those are some pretty significant moves that have no doubt generated billions for the company and will continue to generate billions for the company going forward. So I bring that up to say that no matter where a company is headed, it's always a good idea to look at the management of the company, among other things, and look at the track record. So like I mentioned, if you look at Bob Iger's track record, he's this very special case because you can directly look at what happened the last time he ran Disney and where he was able to take that company. But if you're evaluating a company and you see a CEO that hasn't been at that company before, it's a good idea to see what else have they done in a company that was in a similar industry or something along that nature that deals with similar technology, just to see how they've performed in that role and see how their leadership could translate to being a CEO of the company that you're interested in. Now, going back to Bob Iger, we can see that since he already has a previous track record of running Disney, we can see the tangible results that can help in analyzing whether or not it's worth putting more money into Disney and also get a better sense of where the company is going as a whole. Now, I say that to say this. Again, this is not the only metric that you can use or the only way that you can analyze a company. But if you're looking at Disney as it is right now, it's well below its pre-pandemic level. But this earnings call shows a restructuring. We're seeing leadership that has a proven track record at that company, not at any other company. Proven track record at that company. The return of the king, the return of the CEO, the return of Bob Iger, okay? This is a guy that took he took Disney from 50 billion to 250 billion and is responsible for a lot of success that you're seeing right now. So if you factor that in, on top of the news out of the earnings call that not only are their segments steadily growing, but an underperformer during the pandemic is now back to pre-pandemic levels and is projected to go forward with even more revenue and more profit going forward. You combine those things, and in my opinion, I believe this bodes well for Disney. But that's just my opinion. I'm not a financial advisor. I'm not saying go invest in Disney. I'm just saying looking at a company, these are just two of the important measures that you want to take a look at. Management and also valuation. Nothing, if anything, is fundamentally changed, which in this case, I don't believe it has. The company just keeps on chugging along. It's just that a revenue segment that was lagging behind due to a black swan event, i.e. COVID, has now finally started to catch up and recover and is also projected to bring more profits going forward. But I want to hear your opinion. What do you think about Bob Iger? What do you think about Disney? What do you think about this whole restructuring? Leave your comments and thoughts down below. Thanks again for watching. I'll catch you in the next video. Peace.